All right, perfect. 11:01. Looks like we have everybody in that's going to be in. We might have some stragglers pop in, but let's get into it. Today, we're going to be talking about preparing for trade and tariffs in 2025. This is a huge topic. There's a lot to talk about. We've been holding off on having this presentation as we try to find solid footing based on all the movement that's been going on through the campaign up until now. But let's jump into it. Um, I'm Travis Smith. I'm the president here at TRG. I've been talking to people, companies within the US about customs bonds and cargo insurance for 15 years now. So lots of experience hearing the pains and successes out there. And we're going to try and draw that into today's discussion and what we can expect. I'm also working with Meredith. Many of you are familiar with Meredith. She's our marketing manager here at TRG. She puts out a lot of great content. She'll be helping towards the end of this presentation with the question and answer part. Many of you are familiar with TRG. We got a lot of clients on this training, but hopefully we're getting in front of some new companies also. So just a quick snap about TRG. We're headquartered in Bozeman, Montana. We've been in business since 1991. Our business model is a direct to importer business model. So if you're a US company that ships internationally, we want to talk with you. At the same time, I know we have many customs brokers, freight forwarders, consultants, insurance agents on this call. We're happy to work with customs brokers, freight forwarders, and insurance agents also. We just want to work with good, well-rounded companies that communicate well. But primarily, the bulk of our clients are the importer directly. Currently, we have around 10,000 US custom bond and cargo insurance clients, and we're hoping to grow that number. You can find us on YouTube. We've got a lot of content dating back to, I think, 2012. So plenty of information that overlaps with what we're talking today, and certainly topics that we're not going to hit on today. You can find us on YouTube at Trade Risk Guaranty /TRG. Go ahead and subscribe so you get updates as we create new content. At this point, I want to remind everybody that this presentation is for educational purposes only and does not constitute legal advice. You can submit questions throughout the presentation. If you see in the dashboard, there is a drop down for questions. You can type in during the presentation or after the presentation. We're going to try and answer as much as we can during the presentation. I'm sure there are going to be some questions that we're not going to get to. We will get back to everybody that asks a question later today or soon after the presentation. So if your question doesn't get answered during this webinar, we'll get back to you. So today's webinar topics: tariff news and update, how increased tariffs impact cargo insurance. We're going to take a minute to look at the past, so really 2018 to 2020 in that section of the trade war and how it impacted importers, and really look at bonds from that perspective, import bonds. And then to wrap it up, we're going to look at monitoring your customs bond data, your US customs import bond data. So everybody in this webinar either ships internationally or is a service provider that helps companies that ship internationally. We got the tariffs that are changing. We're going to look at how it impacts cargo insurance, look at what we can learn from the past, and look at how we can apply it to the customs import bond based on data provided. So the tariff news update. How do we structure this conversation? Because there's a lot of moving parts with what the administration's saying, what had been said through the campaign, what we can look at in the future. But there is some clarity. And before we dive into it, I want to silo it into three sections. First being a memorandum that was put out just on the 20th last week. America First Trade Policy. The administration put this out. It was a formal document that did provide some clarity. We're going to first dive into that and give an overview of it. After the webinar, we will send out the formal memo to everybody attending. Encourage everybody to look at it individually and highlight what you think applies to your company. But we'll talk about that memo. Next, we'll move on more kind of to the abstract, what's been said in interviews and speeches, and how that plays into what we expect. And third, we're going to look at what tools the administration has available to them to actually increase tariffs. How quickly can they increase tariffs? What tools they might use, whether it involves other branches of the government, being Congress. So that's it. We're going to look at the memorandum. We're going to look at what's been said a little bit more off the cuff, and then what tools the administration has in place to actually implement higher tariffs. So jumping into this memo came out January 20th. It was titled America First Trade Policy. It has many bullet points and we'll dive into them, but one of the big takeaways is it's asking federal agencies to report to the administration on many different topics, and we'll talk about those topics. The date to have that information to the administration is April 1st, 2024. That led us to believe, after first review of the document, that any increased tariffs or changes to tariffs wasn't going to take effect until after these different reports were provided to the administration. Well, that relief lasted for about 4 hours until we saw news about the Trump administration talking about 25% increase in tariffs on Canada and Mexico as soon as February 1st. And we'll talk about that after we talk about the memo. But with the memo, we thought we may have a bit of a timeline to push back on action until around April 1st, but then talk made us believe otherwise. And we'll talk about that here in a second. But diving into the memo more, what information is the administration looking for? First, they want the causes of the U.S.'s annual trade deficits in goods, as well as the economic and national security implications and risks of such deficits and appropriate remedial measures such as global supplemental tariffs or other policies. So right there, that was a big talking point during the campaign, a global supplemental tariff, maybe a flat 10% tariff on goods coming in. Second, they want information on the feasibility of establishing and the best methods for designing, building, and implementing an external revenue service to collect tariffs, duties, and other foreign trade-related revenue. Just eager to hear more on this topic. External revenue service sounds very similar to U.S. Customs and Border Protection. Of course, U.S. CBP is tasked with collecting duties, taxes, and fees from importers, primarily from importers into the U.S. Now, primarily 98% of the time, the importer of record is a U.S. company. Certainly, there are foreign importers of records out there, in which case CBP is collecting duties, taxes, and fees from a foreign company, but that's not common at all. How could the U.S. government create an external revenue service, potentially require importers of records to be foreign companies? That would put the responsibility to pay duties and taxes on the foreign company rather than the U.S. company buying the goods, effectively changing all Incoterms to DDP. That's one scenario I heard. But without diving into it too far, can't wait to hear more about the administration's ideas on an external revenue service. Another group of information the administration is looking for data on is unlawful migration and fentanyl flows from Canada, Mexico, China. That's a huge topic during the campaign. We'll talk about more on that later in this webinar. The administration is also looking for a lot of data, of course, on China, potential additional modifications to Section 301 tariffs on China. Section 301 tariffs took effect back in 2018. The Biden administration didn't remove any of those tariffs, and they broadened the scope of those 301 tariffs. Likely the Trump administration is going to do the same. Other potential Section 301 investigations on China, and they want to hear if the phase one trade agreement with China, which was agreed upon back in 2020 during the pandemic, whether China is acting in accordance with that agreement and appropriate actions up to and including impositions of tariffs or other measures. So revisit that phase one trade agreement that the Trump administration accomplished with China back during the first administration. So China is a big focus, no surprise there. The loss of tariff revenues and the risks from importing counterfeit products and contraband drugs that resulted from the current implementation of de minimis exemption. So de minimis was allowed for, it's been in place, I think, since the Obama administration. Effectively, if it's a shipment into the US that's very low value, less than $800 in value, it can fly through the border without a customs broker touching it with very little documentation. There's no information on these shipments. You hear about Temu, a Chinese company that's selling into the US through de minimis. The problem is we have no data on these shipments. Who knows if the true value of the goods is less than $800 because there's no method to check that. There's no way for us to know that the goods are classified properly. So de minimis is on the administration's radar, and there's going to be changes to de minimis without a doubt very soon. Policies and regulations regarding the application of anti-dumping and countervailing duty laws, including with regard to transitional subsidies, cost adjustments, affiliations, and zeroing. So the Trump administration is looking at new tools to be able to potentially qualify more goods as anti-dumping or countervailing. Just looking at that last one, zeroing. Um, does the World Trade Organization like using zeroing to qualify goods as anti-dumping or countervailing? No, they don't. Do other countries like it? No, they don't like it. But it looks like the Trump administration is looking at potentially using that approach more often to qualify a certain good as anti-dumping or countervailing. With zeroing, effectively, during the study to qualify a good as anti-dumping or countervailing, they get the average cost of the goods sold in the country of origin. Then they get the average cost of the same goods sold in the US. Now, to calculate the average cost of the goods sold in the US under zeroing, they take out that highest tier of cost. So they eliminate the most expensive examples of the selling cost of the goods in question in the US, and instead they pop in the average cost of the goods in the country of origin. Of course, that results in a much lower average cost of goods sold in the US, really potentially allowing the administration to qualify more goods under anti-dumping or countervailing. So anti-dumping and countervailing have been around for forever, for decades. But the administration is looking at tools and ways to expand anti-dumping and countervailing cases. Unfair trade practices by other countries and appropriate remedial actions under applicable authorities, existing U.S. trade agreements and sectoral trade agreements, and any revisions necessary to achieve and maintain a general level of reciprocal and mutually advantageous concessions. And so the USMCA, US-Canada Agreement, NAFTA 2.0 is going to be revisited too. If you're importing under a trade agreement that allows you to import under very low duty, that's going to be revisited. Everything's on the table. Of course, USMCA is a big one. There are countless companies in the US that import lumber, oil, fruits, vegetables with a 0% duty rate. That might change. That's something that the administration is including in this memo to be reviewed. Of course, that ties in with fentanyl and migration. Now, so that's the memo. That's a quick snapshot of the memo and what's highlighted. As I mentioned, after this webinar, we'll send out the actual memo so you can go through it. It's only about a page long and digest it and see what could apply to your company. Now, what has been said? This is the second silo that we want to discuss as far as tariffs. We just got out of a long campaign, way too long. There was a lot of talk about tariffs. And now that the Trump administration is in office, the tariff talk has, of course, continued. Just last week, Trump talked about a 25% tariff on goods from Mexico and Canada as early as February 1st, 2025. That's Saturday. That's right around the corner. If Trump does pull a lever and imposes 25% on goods from Canada and Mexico, how quickly can customs act to actually implement that tariff? The timeline I've heard is pretty dang quick. It's 2 to 4 weeks. So customs has been through this process in 2018, 2019, 2020. They've increased tariffs at the drop of a hat. So they're ready to increase tariffs if the administration directs them to within 2 to 4 weeks. That's a quick turnaround. Of course, the thinking behind this high tariff on Canada and Mexico is to get those countries to work with us to limit illegal migration and the flow of illegal drugs into the US. Trump has also talked about 60% tariffs on all goods from China. And then we get the 10 to 20% on all imports from other countries. These are massive changes. Also, I mean, what did we see just last weekend? The flare up with Colombia. The U.S. wanted to land a couple military planes to move migrants back into Colombia. Bogota fired back and said they're not going to let those planes land. Trump came in and said he's going to impose 25% tariffs on goods from Colombia and potentially raise that to 50% if they don't negotiate within a week. The U.S. imports a lot of oil, flowers, and coffee from Colombia. Colombia came back and said they're going to immediately increase their import tariffs from the U.S. to 50%. Well, that whole back and forth and trade war, that little mini trade war, lasted for about a day. That, in my mind, is an example of how the Trump administration is going to leverage tariffs over and over again to get what they want. So the administration did certainly get a win with Colombia right there. The Trump administration's always also been talking about increased tariffs with Russia. No surprise there. But that's an example of the talk that is happening along with the memo we just reviewed. In that example with Colombia, if the Colombian government didn't come to an agreement with the Trump administration, if they didn't allow those planes to land, we could be currently looking at a world where imports from Colombia will in fact be 25%. You could have pulled that lever, but that didn't happen. It was able to be talked back and they were able to find an agreement. So that's a lot about what's come out formally, what's been talked about, and what can the administration really do on their own. Now, over these next two slides, we got about 7 bullet points of different tools the administration can use to increase tariffs. The takeaway from these slides is that we're not going to dive into each of these deeply. I don't think we need to know the intricacies of each of these tools. But the takeaway is that there are tools in place that allow the administration to increase tariffs without involvement from Congress. Section 122, no investigation required. Section 301, we've already seen that been used and we already talked about it. They're going to continue to rely on 301. Section 338, no investigation required. What else do we have? The International Emergency Economic Powers Act of 1977. This is a big one, IEPA. I like it because it's actually got words in the name, not just numbers. You can relate to it a little bit better. But most agree that this is a tool that the administration will rely on to increase tariffs. If they did have to increase tariffs with Colombia, IEPA would likely be the tool to get that done. He can do it on his own, and it just gives him a lot of power to act and increase tariffs. So IEPA is a new one that hadn't been used in the past. I believe Nixon may have used it, but in recent administrations, it hasn't been used. And we can expect the Trump administration to use this tool. Trade Expansion Act of 1962 revoked China's permanent national trade relations status. This is a big one, and it does require Congress. It would put China in a different category for tariffs. Their tariffs would certainly go up. It would absolutely disrupt, to a great extent, more than we've seen in the past, U.S. relations with China. But is there the want and the will in Congress to vote for measure this going this far? It seems like there may be. There's already talk of it in Congress. It could certainly happen sometime in the next 4 years. Then there's Section 201. We've seen Section 201 in the past. That is commodity specific, and we might see that again be used during this current administration. So the takeaway is Can Trump act on his own to increase tariffs? Yes, he absolutely can. He has a power available with him, a power available to do so. Once he pulls the lever and instructs customs to increase tariffs, customs has thrown out what I've heard a timeline of 2 to 4 weeks to actually implement those increases. So this can happen very quickly. All right, so that is a quick rundown on where we see increased tariffs, what we're keeping an eye on, how we think it might play out. Now, how does that impact your cargo insurance? TRG, we write annual cargo insurance policies. This is a huge part of our business, and we want all of our clients as well as our prospects knowing how they may need to make adjustments. Now, cargo insurance is property insurance that protects goods as they flow through the supply chain. The supply chain and the coverage can include, it basically always includes international shipments, so importing and exporting out of the US or any other country. Domestic shipments, so a shipment that begins and ends within the same country. So an LTL or FTL truckload in the US is a great example. And the third part of coverage that can apply are goods as they sit in a warehouse, because that's part of your supply chain. So that's it, international shipments, domestic shipments, warehouse. Those are the three parts of the coverage that can apply. We get questions all the time if TRG can write stock throughput policies. I don't know why it's generally not a problem at all to write stock throughput policies. And that effectively covers the entire supply chain plus potentially some manufacturing or packaging if the client needs it. But that's a quick snapshot of what cargo insurance is. Now, what do companies do for cargo insurance? Some companies choose not to insure. They maybe are thinking they can rely on the carrier's liability insurance, which is a huge loophole, and it's not really advisable to think that will cover you in the event of a claim. Second, US companies might be relying on their suppliers to secure insurance, which would be CIF Incoterms. So the supplier secures insurance for the shipment to the US port from an overseas insurance agency. You could imagine what type of frustrations that might lead to in the event of a claim. Communication can be very difficult. The third way to secure insurance is per shipment insurance, where you pay the freight forwarder on each individual shipment. The typical rate to secure that insurance is between 0.3% times the insured value up to 0.6% or higher. During the pandemic, we certainly saw higher rates for per shipment insurance, and they're still in place. And the fourth way to insure is an annual policy. That's what TRG does. If you ship more than $200,000 worth of goods a year, you should secure an annual policy. At $200,000 in volume insured, an annual policy will be the most effective way to insure. So let's jump into it. With cargo insurance, with these increased tariffs, you got to be thinking about the valuation. The valuation is the agreed upon calculation that the insurance company will use to determine how much they're going to pay out in the event of a claim. So claim happens, great. How much do we get to the insured? The traditional valuation is CIF plus 10%. That 10% is a 10% uplift. It's cost plus freight times 110%. So the cost is the cost of the goods you're paying the supplier. The F is the freight to get the goods to the US with a 10% uplift. Now, historically, that 10% uplift accounted for customs duties, customs broker fees, any ancillary fees. Now, of course, as we talk about potential tariffs of 60 or 25%, that 10% is not going to cut it. So how do you remedy that? How do you get to a better scenario? And we're going to go through a quick example in the bottom left-hand corner of this slide. It says CIF 10%, traditional valuation. Total CIF value, $100,000. So that $100,000 represents cost of goods plus freight for the shipment. The uplift is $10,000. That's the 10%. Total CIF plus 10% value, $110,000. You got to apply a deductible. Traditional, the most common deductible is $1,000. So the policy pays out $109,000 on this coverable claim. Now, what if the insured has 25% duty rate imposed? We go to the next slide. Again, cost and freight, $100,000. Incurred duty, so paid duty, $25,000. Total loss amount, $125,000. Total amount recoverable, because the valuation is CIF 10%, is $109,000, like we just showed on the previous slide. In this example, the insured is underinsured by $16,000. So if you're hit by increased tariffs, you got to get back to your insurance agent that you're securing the insurance through and make sure in the event of a claim, the valuation will include duty. Traditionally, that valuation will change from CIF 10% to CIF 10% plus duty to account for that duty. Some insurance companies are very liberal with whether or not they'll include duty coverage. Other insurance companies really want to know what the duty rate is and they want some details. But just have that communication now or as soon as you know you're going to pay higher duties to make sure you're not surprised in the event of a claim. The second thing you got to be thinking about is the per loss limit. Every cargo insurance policy has a per loss limit assigned to it. And what we see is many times a company will put a policy into place years ago. They renew it year after year after year. They never revisit that per loss limit, and possibly just the value of their shipments has increased. So they're underinsured. Another scenario certainly is if a company had previously had very low duties and taxes, now has 25% duties and taxes applied. That additional duty coverage, even if you get the valuation confirmed to include duty, you also need to confirm that after the duty rate is applied to your biggest shipment, the per loss limit is high enough to account for that. If you don't adjust, if the per loss limit needs to be adjusted up and you don't request it to be adjusted and a claim occurs and the total valuation of the claim is higher than the per loss limit, you're going to be unhappy. You're not going to be paid out in full. In fact, many insurance companies will assign an underinsuring penalty because you're actually shipping more risk than they had underwritten. So they're gonna penalize you a bit on that claim. So these are two big things you got to look at if you incur higher duties and tariffs on your imports. One, the valuation, and two, your per loss limit. Pop forward for a second. But before we get to that, I also want to mention with cargo insurance policies, there are annual policies and there are there are flat policies and rated policies. Some companies might want to adjust to a rated policy, giving you more flexibility to account for fluctuations in your annual shipments. Because when you see duties change, a lot of companies will see their volumes either go up or down depending on your industry. So a rated policy might put you in a better position to make sure you're not overspending or underspending. And moving from cargo insurance, let's look to the past to prepare for what we can expect now. Keep in mind for this section, with the first Trump administration, he really only dove into tariffs in 2018. Then the pandemic hit in March of 2020. So he had about a 2-year window where tariffs were actively engaged with and adjusted. Now he's in this new administration. Of course, he has a full 4 years. So it's a much wider window for him to engage with tariffs. And here's the visualization going back to 2018. The top lines, you got the increased tariffs going to China, and then you got the volley back, the retaliation, the tick for tat. So it spans between July 6, 2018 to December 15th, 2019. And we can expect something similar whether we increase tariffs with China or European countries or anywhere else in the world, is this type of back and forth. But how did that actually impact our bond clients? Keep in mind the required U.S. Customs import bond. Any company that imports has a bond on file. It's determined based on the duties, taxes, and fees paid to customs over the previous 12 months, a rolling 12-month calendar. So with TRG bond clients, starting in about 2015, we implemented a bond sufficiency program where our clients get automatic emails as they start to approach their bond limit. So many TRG bond clients increase their bond before the customs increase letter is actually sent and received. And this data doesn't necessarily capture those increases. At the same time, we have many bond clients that will prepare for the increase, but they want to hold off till the last month until the increase letter is received. And that's what we're seeing here. So this is looking at 2018. Man, was it quiet for January, February, March, and April. Very few increases. 1, 3, 2, 4, and then holy moly, holy Toledo, 16, 31, 18, 35, 10, 19, 25, 15. Those numbers might not seem too big, but they are a result of the increased tariffs that our clients experience, and they're higher than we had ever seen before. Now, keep in mind, these are clients that actually receive the increased letter from customs. Many of our clients increase before that letter is sent, but you can see the corresponding dates. And then you look at 2019 and you see numbers in the 50s as high as the 70s. So, we are trying to get in front of all of our clients, make sure they're looking at emails from TRG in case you start getting those automated sufficiency emails. And then naturally, if you're an importer getting a bond from anybody, the risk is you don't get that physical piece of mail that customs sends requiring an increase. They only give you a 30-day window to increase. So you really got to keep an eye on bond sufficiency. It seems simple, but when stuff's going crazy and tariffs are high and there's demand to get goods in, if you don't increase that bond in time, you're going to have an insufficient bond on file and you won't be able to import. So monitoring your data to stay ahead of your curve. I've already dipped into this a bit. I mentioned we have automated bond sufficiency in place to help our clients. What else? What else do we have? Now, first, it's important to recognize what you can and can't do. You can't control tariff. The administration is going to do what they're going to do. You can't control if customs requires a bigger bond size. If they require a bigger bond size, you got to place at least what they say in the letter. You can't monkey around with that. Often you actually, in practice, have to place something higher. That'll also account for your next 12 months. Now, you can control where you import from. You can change the country of origin. You can monitor your entries. What do we mean by monitoring your entries? Making sure the valuation is correct, making sure that only the cost of the goods is in that valuation. Making sure they're classified properly. It sounds crazy, but there are companies importing under the wrong HTS US code. If you get the correct HTS US code, it might be a lower tariff rate. Monitoring your bond sufficiency, like we just talked about. What else? You can look at FTZs, foreign trade zones, drawbacks. You can look at temporary imports under bond if you are bringing in goods just for manufacturing and then sending them back out. That can apply to many different scenarios. First sale. First sale is very interesting, where if you are the U.S. end buyer of the goods, but you're buying them through a middleman, say that middleman is buying the goods from a Chinese supplier, through first sale, if you can check all the boxes, you can clear goods through U.S. Customs based on the first sale cost, what that middleman pays the overseas supplier, not what you pay the middleman for. Now, that does involve some legwork to make sure you're doing it the right way, but that's a great way to potentially lower your duty rate because you're not paying what you're paying the middleman, rather you're paying that first sale cost, what they're paying the Chinese supplier. TRG gets involved with that because as part of that relationship, a lot of times a middleman has to secure a really specific type of cargo insurance that can be difficult to put in place. But that's one type of policy we have been able to help our clients secure. So we do get involved with first sale from time to time, and first sale can be a way to lower your duty rate. And then keeping track of your import data. What you have on your screen here is the snapshot of the dashboard of TRG's import compliance software. We call it Eagle Eye Ace. This dashboard has a ton of data behind it. There are many other pages that support and feed in to this import compliance score, the trade compliance score, and the unliquidated entry score. It also shows any demands on surety. So all TRG bond clients can enjoy access to this software And one of the big intents behind the software, besides giving you all your data at your fingertips, is we assign these scores with these graphics. You'll be amazed how being able to show people within your company a score tied to your compliance performance can help discussion, can help break down silos within the organization. It really drives home maybe the finance department will help understand compliance better and provide more support and have better communication. All TRG bond clients can use this if they want. Um, it takes no IT integration. We keep the cost very, very low. We just feel this is an amazing tool that is a really basic 101 that US importers should consider, especially if you import frequently. Here's another snapshot from that software. Again, there's a lot of data behind this, but this is the bond sufficiency page. In this example, the client's at about 50% bond sufficiency. So at any time, you can log in with your username and password and check your bond sufficiency. There's more data behind this page. If you go to the summary, here's a quarterly breakdown. We break down your duties, taxes, and fees on a rolling 12-month window. So you can see it just like customs looks at it when they consider your bond sufficiency. As you consider possibly increasing, you can see if you're trending up or down in duties, taxes, and fees. But this is what customs looks at, and we think this is really important. It's not rocket science, but you have to have the bond. You might as well have this type of support along with it. You effectively start to get something out of this bond that you're required to have that only protects US Customs. Where do we get the data from in this software? This graphic on the right, you get Customs and Border Protection up there up top doing their best. On the right side, you get the bond from TRG. As your bond provider, we get data dumps from Customs. We get surety ACE data. We are the surety agency for the surety bond, so we get surety ACE data. We manipulate that data, we make it look pretty, we make it available to you so you can have the data at your fingertips. Alternatively, and the TRG data shows information for all data under a TRG import bond. That's what we have access to. The alternative is you sign up for ACE, you get access to ACE, you go into ACE, you pull reports. ACE is a great tool. Many of our clients that use Eagle Eye ACE also use Importer ACE, but the feedback from the industry is that ACE can be clunky, it can be a bit frustrating, it's not necessarily the easiest system to access. TRG's Eagle Eye ACE is super simple. Importer ACE does provide more data, but we're giving you everything we have access to with TRG Eagle Eye ACE. So there we are. We are a little bit over. I apologize for that, but we did cover a lot. If anybody has questions, now's the time to ask. Meredith, do we even have any questions?
Yeah, we had a couple. I've kind of been answering them as we go. But if you want to give everybody a little bit of time to submit their questions, you could kind of go to the next slide, talk about
Okay,
TRG,
yeah,
because I think we
yeah,
are
we
going to
got this.
get, yeah.
Yeah, we get this slide too. We might get cut off here in a second, but a reminder about TRG, direct to consumer business model, save time and money. That's what we try and do. We try and simplify things for all of our clients, multi-year billing cycles. Our bonds work with any customs broker, freight forwarder. We'll work with any customs broker, freight forwarder, in-house claims assistance from licensed customs brokers. Um, we love anti-dumping accounts. Anti-dumping is mega difficult right now. So if you import goods subject to anti-dumping or countervailing, we might have a very good solution for you. And then, yeah, we're back to questions. Is there anything we need to answer right now, Meredith, or we're about to be cut off? So,
Yeah, I kind of answered a couple. We have one that just came in. I'm trying to see. I mean, we had one that just came in about importing steel. So, if right now, basically, if we can see steel going over the 25% that it is currently at.
commodity
Which I don't,
specific
yeah,
questions, yeah, we're
yeah,
gonna have to just talk to you, and I apologize. So much of this is just trying to look in a crystal ball and make predictions, and we just can't do that. So I realize people may have
yeah,
attended this webinar looking for direct answers, like that, like what's going to happen with Could tariffs on steel go over 25%? If Heck yeah. I guess since I just said we might not answer it, but let me just think about that and digest it. Heck yeah. I mean, if you're importing the steel from China, they're talking about 60 to 100% on China. That feels crazy saying even now, but that is the talk that we're getting right out of the administration. So um, if steel from China, yeah, it could be more than 25%. I guess right there's the answer.
So one question we had is how we talked about that it takes a few weeks for customs to implement the tariffs, and will they be retroactive?
I,
Now, just talking from last trade war, you can expand on this, Travis, but last time the tariffs were imposed based on the date of entry. So they would typically give you a date that the tariffs would start at. So if they said every entry made by, February 1st is going to be subject to this, then it was every entry made by February 1st. And so if you had already filled out your entry summary, you made entry, that entry was arriving at the port after February 1st. Also keep that in mind. There is the date that you submit your entry summary, and then there's the date that the goods actually arrive at the port. They were actually going by the date that those goods arrive at the port. So it had to be that you filed your entry summary and the goods had arrived to the US port. So filing your entry summary early to get ahead of that date doesn't necessarily work. It really was by when your goods arrived. But that's how it worked last time. I would assume it's going to work pretty similarly this time. I don't know if you've heard anything else, Travis, though.
no, I think you hit the nail on the head. I mean, we can look at what happened in the past as an indication, but who knows? Sorry. Um,
Yeah, but
yeah.
they didn't go, so let's say they gave you that February 1st date and you made entry right before that. They didn't then go backwards from that. They did hold true to that date last time. So there was at least that. But I will say that once we see these things start to officially get announced, if you start seeing dates applied, you really want to pay attention to that. Like this is going into effect by this date, and you really want to pay attention to that date and start kind of getting your ducks in a row, hopefully before that date comes. So, and that's the confusing thing right now is right now we're seeing a lot of things in the news that are, kind of speculation or things that are being said, but we haven't seen official, this is happening kind of publications. And typically those publications come from the Office of the Trade Representative. So you're going to see them announced in the news, and you can always kind of look on these government websites to find the official memos.
So much of what Trump says is, you latch on to the 25% from Canada or Mexico. I mean, that's what my mind immediately went to when he made that statement last week. But if you read the full statement, he says as soon as February 1st. So there's plenty of wiggle room there. And, even leading up to, what he said before, likely is they're considering as soon as February 1st. So, yeah, you got to look for formal announcements from the U.S. Trade Rep. And be careful. Don't get too emotional about what is said. It's all a negotiation, and you got to keep an eye on it. We tried to hit on it appropriately without too much focus on what was said, but that's part of it.
So we do have a couple that I do want to get to. One quick one, real quick. Somebody just asked that they attended a webinar yesterday that stated that 301 was pushed till April 1st. Is that correct? That's going back to that memo we talked about at the beginning of this webinar. Um, I would say that a lot of that does mean that some of these determinations have been pushed till April 1st, but there have been other things that Trump has stated that he wants to impose before that date. So it's when you're asking, is that correct? Again, we're kind of in the state of kind of wait and see. Um, but speaking about specifically, that's kind of why Travis is saying go to that memo, look at the points of that memo, and literally, I mean, print it out if you have to and highlight the parts that might affect you. Um, because what that memo is doing is it was basically a memo from the Office of the President saying, hey, like, we want these things reported on so that then we can make a determination. So they were saying, look into how China 301 tariffs could be expanded, let's say, which that was, I'm paraphrasing, but that was one of the bullet points. They then want a report by April 1st, and then they're going to take action. So that's why in the industry, we've kind of almost breathed a little bit of a sigh of relief, thinking like, okay, some of this stuff is going to get pushed till April 1st. But again, he's kind of mentioned some other things that he wants to happen as soon as February 1st. So
Well, yeah,
we're,
Meredith, and the other, yeah, I mean that even hearing you talk about it, the other thing to keep in mind is those reports are due by April 1st.
mhm,
Many of these agencies that are doing this reporting might have these reports ready for the administration much earlier, allowing the administration to work to act on that data earlier than April 1st. So
mhm.
that April 1st, it's a soft indication.
Um, so we do have a question just, I mean, this is kind of specifically on TRG of how can you help with anti-dumping? Kind of what did we mean by that? If you want to go over that kind of briefly. I know that's a little bit on a case by case
Okay,
basis,
yeah, sure,
but yeah.
certainly. Just to touch on that very briefly, uh, anti-dumping is difficult. There's no two ways about it. If you engage in anti-dumping, you got to do it with eyes wide open. You got to really look at your options. You got to understand it from many different perspectives, from customs perspectives, from your stance in the marketplace, how much you can make off these goods. And I believe it's very important to understand it from the insurance company's standpoint. The insurance company has a perspective on the risk they're incurring. When you understand it from the company's perspective, you have a much more well-rounded view of anti-dumping, I believe. Um, Historically, traditionally, if you import goods subject to anti-dumping, the insurance company underwriting the bond is going to require full collateral. So if it's a $50,000 bond, $50,000 in collateral. If it's a $2 million bond, $2 million in collateral. That's the standard practice. And it's not unusual for that collateral to have to be stacked year over year for sometimes as long as 4 or 5 years. But in any event, with anti-dumping, by and large, in my experience, I don't want to say 100% of the time, but up until recently, I'd say 99% of the time, full collateral is required. Now, TRG has implemented an anti-dumping specific underwriting program where if we can qualify the importer of record, we do have approaches that can help you secure the import bond without collateral. So without getting into it too deeply, that's what I was talking about. We're the bond provider. So we feel if we can qualify your goods or your company that's importing goods subject to anti-dumping, we can get you a better option for that import bond. Nobody likes having collateral tied up. That's one of the big rubs with anti-dumping. You want access to that liquidity. And I can reach out to you directly and talk about it. Or you can reach out to us if you have more questions.
Um, yeah, I think we're getting really close to the hour mark, but we had one question that was what prompted 301 exclusions in 2024. Um, I mean, just generally exclusions, 301 exclusions, I mean, you always kind of get the general answer from the Office of the Trade Representative, which is to, now in this case, it was specifically said it was in response to China's policies, practices, and acts related to technology transfer, intellectual property, and innovation. That's a very general answer. Usually, exclusions are used because they have identified whether it's, you know, the 301 tariffs would put a strain on the supply chain. A lot of exclusions are also a result of U.S. industries putting together a petition, basically an exclusion request to the Office of the Trade Representative, requesting an exclusion because they are proving that it would result in hardship to that U.S. based industry. So that's typically why these exclusions are granted and then subsequently extended. Every case is a little bit different as to why they usually do a pretty, at least somewhat extensive uh, look into that industry. Speaking to exclusions coming for any new tariffs, that's going to be potentially a whole new ballgame because we really don't know what that process is going to look like. In the past, again, there would be an exclusion request period where you could submit your request. Now, it had to be, officially done. It couldn't just be, you know, um, like it's not just a web form, it's a pretty big, extensive process, but you were able to request exclusions and then potentially they would be granted. But yeah, typically those exclusions are in order to kind of allow those goods to still move more freely, or there's been usually a US based business or industry that has proven that it would really hurt their industry, whether it's in terms of jobs or you know uh, cost for end consumers, things like that. Um, so typically you're able to make your case at least a little bit, but keep in mind that this is a very overwhelming process for, us in the industry. It's also a really overwhelming process for US Customs, for all of these government agencies that are kind of trying to also play catch up. Um, so Travis, we do have another question on first sale. I feel like this one might be better for you to answer more specifically, because I don't really know if we have time to get into all of that. Would you like to just kind of answer that offline,
Sure. I
or
can't
should
see
I
the
ask it?
questions right now. My screen is kind of low. We
Oh,
got
okay.
like 7 minutes left. Yeah, go ahead and ask it. We'll see if we can give them any good context.
Okay, so this question was with first sale, how would that work with apparel? The agent in some cases is working for or with the factory and due to different issues can offer a discount on the apparel so that sale goes through and isn't canceled. Would that then not meet the three-part test to determine applicability?
We'll call the asker. I don't want to get too
Yeah,
far
I
into
feel
it.
like that one
Frankly,
is a pretty
yeah,
specific question.
I'll be able to provide you some context over the phone. We might direct you to a trade attorney that actively always helps with first sale. TRG understands it from our perspective, and we know where we can fit in to help if you're going to apply first sale to your supply chain. Um, and I felt during this meeting it's absolutely valuable for importers to have a broad view of first sale and know about it, and then decide whether or not you want to take it further. So I'll reach out to you directly. Sorry, I can't give you more now.
All right, last little question that came in here was, as an importer to the US with a sister company in a foreign country, if the tariff collection is changed to DDP, we would
Okay,
or would our foreign company be the importer of record or the mill we buy from?
that topic, the External Revenue Service, is such a
Mhm.
new idea. I mean, when I first read about it, I said, "Holy moly!" I mean, that's way out of left field. In my mind, it sounds good on paper, but how do you actually implement it? What money do we collect from overseas companies? Um, and the only kind of approach I could see working is one where you would require the overseas company to be the importer of record. That would be a big change. Um, I really don't know how to answer your question without talking to you. And please understand that that's a theoretical scenario, nothing that the government has put out. But you got to draw some conclusions or try to put what they're talking about with an external revenue service into context. So I wouldn't worry too much about. I don't want to say don't worry about your question, but that external revenue service topic, we got to get more details before we can talk really concretely about it. So sorry for the non-answer.
Well, I think also this question was talking about DDP duties delivered paid as well.
Oh, so yeah, so DDP,
Yeah.
the seller, the overseas company,
So if and if their
they
company is the overseas
yeah.
company, like they have a
So
sister company.
so you have a sister company. So I mean, the sister company agrees to sell it to the U.S. buyer, which is a subsidiary. It sounds like at a cost that includes the cost of the goods, duties and taxes paid to customs, and freight. So everything's wrapped up in that DDP cost to get it to, I forget where, I think the buyer's door. I think you're asking if with DDP you can claim the value that your parent company overseas is paying the mill. Is that what the question is?
Yeah, so well now you have me going back. So it's basically they're an importer into the US with a sister company that is located in the foreign country. And they're asking if they change to DDP, would the foreign company be the importer of record or the mill that they buy from, who I believe is also then in that foreign country. So,
Yeah, they
um,
can be the importer of record. Yeah. If you, I've run into companies that it's kind of screwy, and I've run into companies that import on DDP Incoterms and they import on their own bond being the U.S. company, which I think is the exception. I also certainly run into companies where the foreign company is selling to the U.S. on DDP Incoterms, and the foreign company is the importer of record with their own importer, U.S. importer bond on file.
okay, I think that is all we have time for at the moment. We're right at the 3 minute mark, that we only have 3 minutes until we kind of our allotted time. But I think that is all of the questions that I think we were able to get to pretty much all of them. I've been trying to kind of answer some of you guys here in the chat as well. So if there's any we missed, we will reach out. We'll probably also reach out to some of these ones that are a little bit more specific. So there's that as well. I also, just as a global answer, we will be sending out a follow-up email after this webinar. It's most likely going to come either later today or tomorrow morning. We like to edit the webinar and send the recording out in that follow-up, so that just takes a little bit of time. So in that follow-up, you'll get the recording. We can also include a link to the slides. So, and if you have any questions, hopefully you can ask them there as well. Yeah, Travis, I think if you just want to wrap it up, that's
Yeah,
all for
thanks for everybody for attending. Keep an eye out for communication from Meredith and TRG. We're going to be doing more of these, and good luck. Let's try and have fun with all these changes.
and thank you for attending.